see that it was only at, well, 13 minutes ago. So 13 minutes ago, there was an arbitrage. You can see that we took the buy trade on our books, and we did a screenshot. So you could see what the trade was. It was the red candle right there. So there was the buy trade right there at that red candle. You can see at $88.15. You can see very quickly it was trading $88.30. So a 15-tick profit in 60 seconds. Just to show you that it is possible, guys, to make a lot of money with a very high level of safety very quickly. Very quickly. So, where is it on that screen? Well, you can see it. It's the arbitrage visible trade. The arbitrage that we can obviously see on that screen is this trade here, isn't it? There it is right there. So this is exactly the trade that we've been talking about this morning, wasn't it? The idea that the red is at a premium to the blue line, and that the blue line is driving down at the same time as the red is driving down. You can already now recognize that that is now an arbitrage trade. Does everybody now agree that that is an arbitrage type trade? It's similar in vein to the gold arbitrage trade. It has directional quality about it because of the blue line. It has premium quality because of the red line. And it has that extra bit of quality because they've actually not waiting for the trade. They're actually doing the trade. That's the big difference, isn't it? So the conversation was about how wide a spread do you let the spread become before you start executing, which is the biggest single challenge that any R-squared type trader has to answer. So if we have a narrative, for example, where we have a positive correlation, and I said to you, right, the positive correlation is here, and the trade is that you're selling the red line here. You might say, oh, well, there it is. There's the buy trade. Really? Where's the buy trade? Well, it's there, isn't it? There's your buy trade there. What makes you think that's the buy trade, right? Because if I was to break this red line down into, say, 5 components, the same thing happened here. So why was that not a buy trade? The same thing happened here, so why is that not a buy trade? The same thing happened here, so why is that not a buy trade? And the same thing happened here, so why is that not a buy trade? You see what I'm saying? In other words, the spread is still widening. The spread is still widening. Now, one of the ways we get past that is to answer the question of what could make it a buy trade. What could make it a buy trade is that it hits a particular level in the background that's of relevance, right? Because we've maybe seen action at that price before. What else? So that's the first thing. So it could hit a prior level. That's one thing. But because it's hitting a prior level, is that always going to be a reason for buying or selling a market? Yes or no? Not really. It's not always going to be a reason, is it? Sometimes it is and sometimes it's not. So because it's hitting a prior level, what else might be happening? There's a chance that we may see a big increase in volume. Now that's obviously even more important. Why? And so it's more important because obviously it means somebody somewhere is doing something with that particular value. Somebody somewhere is doing something with that particular value. Is it absolutely convincing that it's somebody somewhere doing something particular with that volume? Is it 100%? Still no. Why is it still no? Because the volume might be somebody exiting a prior move. There might be another reason why it's happening in the background. There might be other things that could cause that volume to appear. So therefore, whilst it's convincing, it's not 100%. Again, it's just an extra bit of probability. Do you understand? So how do we finally get to a conclusion about this thing? Well, we get to a conclusion about this thing because we don't know if the red line's going to keep going. I mean, there's always that scenario that the red line may explode like that. We may well do it, right? May well do it. In which case, we're probably going to lose a lot of money. But what if the red line did that after the big volume came in? What if the red line did that after the big volume? And we started to see the blue line doing that after the big volume came in. Now that this is happening here, we don't just have the prior level. We don't just have the big volume. We now know the spread is trading. Somebody, somewhere, has decided to act on that spread. You see the difference? And that makes it a really high probability trade. We're starting to now get that incredibly high probability narrative. So obviously, prior to this taking place, you can see that this candle really had none of those elements. It didn't have a prior level. Obviously, that red line is not at a prior level. The blue line is making a lower low. So there is value to buy this trade, absolutely value to buy this trade. But what actually was more important to me was look at the price action on these types of trades. Look at that pinning of the bottom edges through that whole phase. You see it? So that pinning, somebody's absorbing that business, isn't it? So you're starting to build a storyline involving this. And because the blue line has made a lower low through that phase, the value has re-established quite significantly, hasn't it? The blue line's made a lower low. The red line at that stage is actually quite easily visible as making a higher low. So we know that we can certainly buy oil, that's for sure. So the value is in it. But more than just the value, the fact that somebody's acting on that spread is the main reason why we've now got an incredibly high probability opportunity to do a bit of business here. Somebody's actually acting on that spread at 15. So I can come in here and I can start bidding the 15s, the 16s, the 17s, whatever I can get some business done in here. And obviously, you can see that I'm buying against a sell book. I'm buying against no levels. You know, we obviously ran a little stop run in the background against these pins, but the big level obviously was just a little bit lower than that. But I'm buying against those levels. I'm even buying against a little bit of long-term supply in here. It's not exactly tearing off to the sell side, so I'm not that concerned. The short term, you can see when I took the screenshot, the short-term demand was visible. And obviously trading into that area, all I did was buy it against, as I said, a very, very strong sell-side looking order book. Well, that's a bit bold, isn't it? That's a bit aggressive. But there we go. We've managed to get the trade on. We've managed to make ourselves a quick profit of 15 ticks. And we were chatting about this earlier. We actually watched a trade develop into effectively a $1,000 five contract trade that made $1,000. And we talked about several of those $1,000 trades on a 5 lot. And we're just discussing how much you would have to trade to make, you know, your $1,000 a day trading a 1 lot, for example. Trading a 1 lot, you'd have to work probably a couple of hours, wouldn't you? So when you think about that, to make $1,000 a day, you'd have to work a couple of hours if you're trading a single oil contract. That means that you should easily be able to clear $250,000 a year trading oil as a single lot trader. Is that not appealing to most people? I don't know. Maybe you guys make a lot more than that, so perhaps I'm wrong. You can see into the oil bottom edge here. There wasn't an arbitrage, but there was a statistical arbitrage. There's the trade there. You see it? So there's a statistical arbitrage. It's not an arbitrage because the red line's still rising. The question you always have is, how far is the red line going to go? Because the red line was rising on the previous candle. You see the difference? The red line was rising in the previous candle. The red line was rising in the previous candle. So these are all possible value buy trades, but which trade is it going to be it? You see what's happening? Which trade is it going to be? That's where the challenge lies. We've got a prior level here at the 88 evens. We know that there's a lot of liquidity at 88 evens to trade through. We know that there's a challenge to the stop run. We know that there's a challenge definitely to the stop run. You can see that the reg line's bullish, the reg line's bullish. So there's a challenge to this trade. This is the point I was making about you get the evidence, but it still doesn't necessarily interpret into what? An actual trade. It still doesn't interpret into an actual trade. So you're getting the evidence that you should be buying this, but where do you buy it? Where's the opportunity to play? Well, if we get an arbitrage that times the trade for us, we don't have to worry about trying to time it, do we? But on this occasion, we don't get any arbitrage, do we? Do you see what I'm trying to say? On this occasion here, we don't get any arbitrage. Why don't we get any arbitrage? Well, we rarely get arbitrage. That's why. Why do we rarely get arbitrage? Because they're almost arbitrage. As soon as somebody acts, think about it being a market maker and you start seeing somebody arbitraging something out. Imagine, for example, there was a horse, right? Let's assume there's, who's the last two that's typed in? Mike and Paul. So Mike owns a bookmakers and Paul owns a bookmakers. And Paul's bookmakers is an exchange, so Paul will take backs and lay bets, and Mike's is a normal standard bookmaker, right? And Paul has a horse on at 10-1. And Paul has a horse on at 10-1. Mike has a horse on at 15-1. The same horse. Mike has a horse at 15-1. Well, if that's the case, there's an arbitrage, isn't there? I can back the horse with Mike at 15-1, and I can lay the horse with Paul at 10-1, right? I'm making 5 points in the middle. I'm making 5 points in the middle. How long is that arbitrage going to exist? So I'm going to go to Mike and I'm going to say, how much will you take? And Mike says 100 quid. Well, Mike says, how much do you want to put on the horse? And I say, £1 million. And Mike's like, wait a second, not a chance, mate. Not a chance, £1 million. And then immediately Mike's alerted to the fact that somebody somewhere is doing something, and Mike looks at the screens and Mike notices that Paul's laying the horse at 10-1. And Mike says, nope, I'm changing my price to 9-1. And what happens to the price? Mike's 15-1 goes to 9-1. You see it? It's wiped out. The arbitrage is wiped out because Mike now recognizes that somebody somewhere is acting on that arbitrage. You see the difference? Somebody somewhere is acting on that arbitrage. So obviously if Mike offers me $1,000 at 15-1, I'll take it and I'll put the $1,000 on with Paul. And then Mike offers me 12-1 for another 1,000. I'll take the 1,000 and I'll put it to 12-1, and Paul, I'll put $1,000 with Paul at 10-1. And then Mike offers me 11-1 for $500. I'll take the 11-1 at $500 and I'll do $500 with Paul. And then the price drops to 10-1 each. So the price drops to 10-1. The arbitrage is now gone, but I've got my trade on. Do you see what Mike did? He pulled away his liquidity on the horse. He pulled away his liquidity. So if he pulled away his liquidity, that's what happens on that candle there, doesn't it? That candle there has got an arbitrage attached to it because the blue line and the red line are both falling. So somebody's acting on it. It's not the fact that when Mike's horse got to 15-1 and Paul was still at 10-1, nobody acted on it at 11-1, did they? Nobody acted on it at 12-1. Nobody acted on it at 13 or 14-1 because Mike would have noticed them acting on that horse at those prices and maybe would have opened up the question. In other words, the spread widened and widened and widened to the point somebody says, there's a massive spread opportunity for me to take advantage of there. And because I started to act on Mike's 15-1, Mike pulls away the liquidity at 15-1 and the price collapses on the horse. Well, that's what happened there. The price was dropping, the spread was getting better and better and better, and then I started to act on that buy trade. As soon as I acted on the buy trade, the arbitrage closed. The price exploded, and I made 15 ticks in 60 seconds. And I don't just talk about it, did I? There is the trade right there, guys. There's the trade. It's a screenshot of the trade itself. So it's not just something that you can see visually and never be able to do. There it is, right in front of your very eyes. Right in front of your very eyes, an arbitrage trade that went straight into profit for 15 ticks. Pretty good? Not a bad little bit of business, is it? Not a bad little bit of business. Now, obviously, the point is, Paul might recognise that Mike's right. Mike might look at the horse and say, wait a second, I've got a horse here at 15 to 1 that somebody's willing to back at 15 to 1 and he's willing to put $1,000 on it. What happens if Mike knows something about that horse? What happens if Mike knows the owner or trainer of that horse, and the owner or trainer of that horse says, this horse is not, we're going to run it to lose, basically. Although that's illegal, we're going to run it to lose. You know, it's not fit yet. It's just had maybe a wind operation or something along those lines. It's not fit, and we're just getting it to basically trying to get it fit. So we're just giving it a run. And Mike knows that information. So who's actually wrong is Paul, right? Paul's the guy that's wrong. So Mike will take the bet at 15, right? Because Mike says to himself, well, if you want to put $1,000 on it, I don't care that it's an arbitrage. I couldn't care less that it's an arbitrage. Do you know what I mean? So Mike will say, I'll take, if you want to put 20 grand on it, 15s, I'll take it. In other words, the arbitrage closes from the other side. Because obviously if Mike takes it 20 grand at 15s, well, you know what's going to happen, right? You're going to back it at 15s, and you're going to back it at 15s, and you're going to back it at 15s, you're going to back it at 15s. Mike's not really that bothered. I mean, it is what it is. It means Mike's getting an incredible amount of volume on a horse that simply hasn't got a chance of running because it has inside information on the horse. So sometimes you see an arbitrage and nothing happens, and you say, why did it not happen? Well, somebody somewhere else knows something about that trade that makes it not tradable. That's why volume is a very, very important piece to this jigsaw. But like I said, when the price comes down into the bottom edge here, the spread gets wider and wider and wider and wider. So that's not an arbitrage. It is a statistical build in value. And obviously the key to that trade became what? Since it's not an arbitrage, what was the key to that trade? Well, we talked about knowing when the trade was ready to go. Knowing when the trade was ready to go. What was the clue about when the trade was ready to go? The prior level, of course, or the big volume increase, right? So there's only two other pieces that we can use to try and recognize that somebody somewhere is acting on what looks like a possible arbitrage trade. And that is the prior level trade, but that should bring with it a big volume increase, yes? Well, did we have a big volume increase during that spread? Did we have a big volume increase during that spread? Well, what the hell is that? An enormous volume increase as the spread got bigger and bigger and bigger, as we took out a prior red level. Yes? So we got the prior red level, and then we started to ask for the volume to show up. Because the volume is also somebody taking the deal on, isn't it? And obviously, if it's somebody taking the deal on, there's your opportunity to buy into the trade right there. And obviously, the takeaway from that trade goes 90 up to a high price of 30. That's another $400. Remember I said about making $1,000 a day? Well, that trade there was worth $150. That trade there is worth $400. That's you got $550 of maximum swing potential already on a single contract. You're already up $550 and you've only had these last two trades here based on arbitrage or statistical arbitrage probability narratives. And that means that you're obviously already way ahead of the curve. You're already massively ahead of the curve. You're already in good shape. But there was other ones. In fact, there was an arbitrage actually just a short few minutes ago. You might be able to spot it now. Does anybody spot where the arbitrage is? Oil traders should be all over this, guys. Where's the arbitrage? I'll give you a clue, it just made another $400 per contract, which means that you're now over your $1,000 for the day. That's you already made your target since this buy trade came in here. You've already made your $1,000. Nobody sees it. Unbelievable. Maybe it's just the graphic quality of the chart. If I zoom in, does nobody see a blue candle where the prices are going higher? What about that blue candle there where the red line's going higher and a discount to the blue line going higher? Is that not it? Is that not your arbitrage? Nobody knows. I'll tell you, that's your bloody arbitrage. Thought people would have learned by now. Unbelievable. Right, so we talked about hedging today, since that's as much interest as a chocolate